For those of you that don't know, Joe and I, we look after the captive practice of FiscalReps. We look after just over 80 captive clients based predominantly in the EU, some outside of the EU. We're looking at the Premium Allocations Masterclass today. Part of the material of this comes from some of our training courses, and some of it's come from some sessions that Joe and I have run for AIRMIC risk members, risk managers. We have we're a preferred service provider with AIRMIC, so we do quite a bit of work with them. Just to wake you up before lunch, we thought we'd make a quiz format, which anyone that's been next door has already done a quiz format, so hopefully you're ready to hit the button. We thought we'd try and make it a little bit more interactive by doing that. And again, would encourage questions throughout. We're obviously working on a very general level, which may or may not cover your knowledge base. Okay, so shall we go with question 1? So, again, no answer's the wrong answer. Quite often these questions, there's quite a lot of responses, so we're not going to catch anyone out. Who is responsible for premium allocations on a global programme? Anyone? The insurer. So on the basis of what the broker says.
Yeah.
I would go with the insurer, because ultimately they're going to carry the candidates wrong.
Well, I think the answer could be any of the above, or most likely a collaborative approach, especially when we're talking about large global programmes with a large premium allocation. The local insured or the insured might be involved just to the level of providing values to give the methodology behind the allocation, or where there's a captive involved, the insured may be far more involved than that level on the premium allocation. But ultimately, I think the insurer has to have sign-off and be comfortable that that's what they're signing off on. Question 2, has anyone got any general considerations that you need to think about when you're implementing a global programme that you'd have to take into account at the first stage of putting together your premium allocation? Any suggestions?
Consistency. Follow the same rule.
I think consistency, yeah, that's very important. Actually, we're going to cover that in a little bit more detail later. But kind of the considerations we were thinking about is how you allocate, well, partly how you allocate your premium, but where your risks are located and how you actually package your policies together. So I'm sure everyone's familiar with the term non-admitted insurance. So, for example, an EU insurance company has the ability to write risk directly into Singapore without local paper. So any territories where they're writing non-admitted insurance, the premium will be allocated as part of the master policy premium collected in the UK if it were a UK insurer. Again, under that banner, your freedom of services. Obviously, you've got risks throughout Europe on a freedom of services basis. You can cover that risk under your master policy from another EU country. So, for example, we use the UK. Therefore, your premium in your allocation for your freedom of services will all be packaged under the master policy. However, then broken out for tax purposes, but in that instance it would be part of your master premium. And again, the third element of the master policy would also be your difference in conditions, difference in limits. I'm not sure whether that's a term everyone's familiar with. And basically that's on a global programme where there's local primary policies placed in territory. The DIC-DIL coverage gives comfort to the parent that they've got top-up for conditions and additional limits available under the master policy. The other thing, I suppose, is location of risk roles. We know in the EU, it's the second EU directive that defines the location of risk roles. Obviously, when you go outside of Europe, you may need to change those. I think we mentioned earlier Switzerland, outside the EU, where there's a slightly different rule.
Yep.
And obviously your line of business, so that would be a consideration. Okay, so we were talking about consistent methodology. again, I think it's quite interesting that there's no right or wrong answer, everyone has a different approach, but as a rule of thumb, has anyone got any thoughts about the general methodology that underwriters use for either property damage business or directors and officers business, or would they use the same methodology? Any thoughts on property damage?
Values.
By values, that's the, yeah. Again, I think there's no right or wrong answer as long as you can justify how you're allocating your premiums, the methodology you're using. For property values, yes, we're talking about your actual values at risk in territory. For large risks, kind of thinking of something like an onshore oil refinery, where you've got segregated firewalls, fire breaks, and the event of a maximum loss you think would only cover one area, you might use an estimated maximum loss or a probable maximum loss in that location. Moving on to liability, classic banana picture there. You know, wage roll is fairly common for employees' liability. Turnover is quite common, employee numbers can be used. Again, offshore property is kind of viewed the same as onshore property. And for motor, you know, you've got your local statutory requirements. In the UK, there's unlimited cover. And I think in certain European countries, I think France is one of them, if you've got airside coverage for motor, there's unlimited liability as well to consider. Crime, wage roll or employee numbers are fairly common methodology used. And finally, D&O generally seems to be employee numbers. But again, I think that can differ with the insurance companies. Okay, so getting a little bit more technical into the premium allocation, aside from how you're generally planning your programme, are there any other rules you need to think about or additional costs that you need to build into your premium allocation above and beyond the technical underwriting price? Again, there's lots of these, so and our list may not be exhaustive.
Are you getting taxes? We think you're looking at things like premium, fronting fees, things like that.
Yeah, possibly. And taxes. Taxes obviously a big one for us. Start at the top.
Yeah, I mean, in terms of taxes and tax authorities, in Europe at least, there's not very much out there in the way of actual rules. And maybe just a little bit in terms of guidance. So HMRC actually provides some of the most detailed guidance on what they're expecting to see for premium allocations, and it's essentially that, just a just and reasonable allocation. If it can be justified, explained, and it's a reasonable allocation, then they'll probably accept that. But also started to mention there a bit at the bottom there, the local insurer and insured taxes start to interact with the allocation. The distinction there between an insurer and an insured tax is how that's treated in terms of charging it. So an insured tax or a policyholder tax isn't such an issue because it's an addition to the premium. So you charge a premium, add the tax on top. The problem lies for the insurer taxes, the taxes borne by the insurer, because it's deducted from the premium. So you have to be aware of these insurer taxes that are around there, gross up your premium accordingly to ensure that you're still collecting the same amount of premium that you want, or retaining the same amount of premium that you need, whilst having that extra bit that you then pass on to the tax authorities. I suppose I briefly mentioned terrorism pools in no particular order here. We're just going all over. Terrorism pools, there's similar sort of issue there. You have to be, I mean, quite often terrorism pools act, look, smell like a tax. You know, they have to be collected, they have to be remitted, they have to be paid into the pool, or possibly retained. But maybe some specific examples which can impact on the premium is in France, where you have the additional Gariat premium and the catnap premium, which sort of comes off of the original base premium, charged in addition to it.
Okay, as Ken kind of mentioned, minimum premiums or the cost of fronting policies. You know, where you've got your values, and your value in a country might be very low. When you allocate the premium, it may come out at £2.26 or something for that territory, which probably isn't an equitable amount to be invoicing locally. So lots of insurance companies suggest minimum premiums for risks in that instance. We'll talk about the transfer pricing in a moment. Local compulsory retentions and sessions. Again, particularly when, you know, on a global programme where the risk is coming out and back to the insurer at the centre, I think, you know, many people are familiar with kind of the BRIC countries with the state retentions and sessions. I mean, my own experience of dealing with the IRB in Brazil in a previous life was that, you know, you think you knew what was coming out when the money came back from Brazil. It was never what you expected. There was never a breakdown. It was quite hard to calculate what had been deducted. But there you are, and I suppose that was probably more of a more specific example. But again, India, China have quite strong retentions and sessions that are required locally before money can come out. And again, also you see it in kind of French-speaking Africa. I'm thinking Morocco, Tunisia, the state reinsurance companies that hold money in. So again, if money's coming out to a captive or back to insurer, they have to build into the fact that they're going to see possibly a small bit of the risk as well, but some of the premium's going to stay locally. And then again, going on to transfer pricing, I think with regards to the profit sharing, the area where this is going to impact your premium allocation, mostly, you know, a simple example where you've got risk in Finland versus risk in Ireland. In Finland, you've got a 24% rate of tax, in Ireland a 5% rate of tax. You know, if you're shifting your premiums, it could look like you're avoiding paying certain tax rates in certain countries. I think that's the element of the transfer pricing that's applicable to premium allocations. And a slightly more technical question around Spain. And checking as to, does anyone know the tax point in Spain and why it's relevant to the premium allocation?
Karen actually said at the start there are no right or wrong answers, but in this one there may be.
There may be. But there is a slight clue that there are two tax points in Spain. If that helps anybody. Has anyone been to a Spanish session this morning? Was there a Spanish session? Yeah.
Yeah. Yeah. So we have two tax points. The IPT should be declared on a cash received, or maybe more accurately a cash paid basis, which then doesn't really impact onto the allocation because it's only triggered once the premium has been paid, and the premium hasn't been paid until obviously the allocation has been finalised. However, the consortio contributions are due on the inception of the policy. And if there's any delay in getting the allocation finalised, you may be late in actually being able to declare an accurate figure if you declare anything at all. So it highlights the importance of getting from a premium tax perspective, of getting the allocation finalised before the inception. There are a number of taxes out there which are triggered from the start date or renewal date of a contract, of a policy. But the one that comes up a lot is the consortio, because of the implications of not having paid it on time, or not having paid it correctly. The consortio being sort of the state reinsurer, as it were, not reinsurer, the state catastrophe pool, will not pay out a claim for the additional cover that they offer should the consortio premiums not have been paid on time. And equally, if they're not paid correctly, they may not provide the full level of cover. They may provide some, but only based up to the amount that has actually been paid. So finalising those figures and getting them absolutely right is very important at the beginning. If you haven't and they don't make the payment, then the insurer is exposed to additional risk. Should a big claim come in, an extraordinary risk declared by the government, and these haven't been paid correctly, the consortium will reject it, the insurer will then have to meet that claim.
I think the message there is that the premium allocation needs to be finalised before the policy incepts or renews. I mean, and I think in recent years that this is far more common. I mean, I'm going back 10 or 15 years. When I was working with an insurance company, I can remember a client that renewed on the 1st of May. And by the 28th of May, I think we'd seen 5 different premium allocations, none of which were finalised. I'm guessing they didn't have consortio cover, that was a property risk, but yeah. An interesting one, unless that was the premium that didn't move. Okay, so any thoughts as to what the common pitfalls are of premium allocations? What can go wrong, the implications? In fact, I think the best way to kind of demonstrate the first part of this response is a query we had on a captive client from HMRC a couple of years ago. It was a European-based captive writing into the UK with one large premium a year. The parent company sold a rather large asset in the UK and a refund was processed. HMRC requested a meeting, and it was quite interesting as to what they did actually look at. You know, it was the fact that it was a large figure that had kind of raised their attention, but they wanted to see copies of the actual policy document. They wanted to understand the methodology of the allocation over the last 3 years, not just the current year, to see that they've been consistent. They also actually got their calculator out and in the meeting, calculated the return premium that was correct. And actually in that instance it wasn't, because when they'd prorated the return premium, they'd actually flipped it, so that the premium they should have kept, they tried to refund. So that was wrong and had to go back and be corrected. And again, as I say, they looked at not just that year's methodology, but for consistency. I mean, there was no further inquiries. It was a genuine refund, but potentially that could have led to a further audit, potentially. We've got some more implications of allocations, incorrect allocations.
So, first one up there, fines and penalties. I mean, we've discussed the consortio and the impact there. There would also be fines and penalties if they were filed late or incorrectly. But if there's what a tax authority perceives to be an unfair allocation, they may seek to reallocate premium to their territory, to their country, and look to then collect the taxes on those amounts. Obviously then, you could be a late payment, a late declaration, incorrect declaration, and the fines and penalties will therefore follow, depending on the tax authority concerned. In terms of reputation, I mean, we've briefly mentioned the transfer pricing, but certainly from the tax perspective and the tax authority's perspective, that maybe going after this. And as it's become very, very hot topic now about big corporates not paying their fair share of tax, the damage of not having done this from a reputation perspective could far, and probably would far outweigh the penalties imposed by the tax authority.
I mean, going into criminal charges, I think really we're talking about a regulatory breach here, writing non-admitted insurance. The one example that came to light when I was thinking about this was, I think in Mexico, the local insured can be put in prison for buying non-admitted insurance, or it might actually be the insurance company. It might be impact on both of them, but I think from a regulatory perspective, in your premium allocation, if you're allocating premium to a country, but not issuing a policy where you're not able to write it on a non-admitted basis, you're putting in writing that you have risk there. So I suppose the exposure in the event of a large claim in that country that got to the attention of the press could get to the attention of the regulator and could have an impact on the insurance company and the insured. And again, the final one here isn't really an implication on the insurance company as such, but more on the insured. you know, where the insurer is providing perhaps difference in conditions and difference in limits coverage under the master policy. In the event of a claim, they will pay that to the parent who has the financial interest. That's all above board. The insurance company is completely compliant. However, the risk manager or the parent company, if they then wish to pay the money internally back to the country that's actually suffered the loss, they potentially face corporation tax charges. You know, I have a quality example of one particular poor client, when I say poor client as in a bad experience, had a DIC claim in Russia, difference in conditions claim in Russia, and a difference in limits claim in Colombia. Both were in excess of $1 million, and when those claims were tried to be repatriated internally within the group, there was in excess of 20% income tax to be charged on both the claim amounts. So again, that's something to be aware of. It might not impact the insurance company, but it might impact the insured. I think on the back of that, we've got a very kind of a basic common sense compliance checklist, audit trails, reviewing your allocations for accuracy, ensuring your insurance company and brokers have the adequate controls, and making sure you're developing your own expertise. And I think the final point on the implications of incorrect allocations comes down to the tax authority views.
And we mentioned earlier that there's not really any strict rules or guidance coming from the tax authorities, but the economic environment, governments under much more pressure to raise revenue, and then subsequently tax authorities under pressure to raise the revenue, close loopholes, IPT is becoming under more and more scrutiny. Now, I've not yet seen a tax authority look at a premium allocation and completely disagree with it. And indeed, tax authorities, certainly in the IPT departments, don't have currently the expertise to sit down and actually say, you know what, I disagree with your allocation now, I don't think that's right. There's not the knowledge, there's not the experience there to do it, and there's not the capacity there to do it. And in fact, if you are able to just land a load of papers on the tax authority's desk and say, this is how we've done it, they'll look at the first few pages and say, okay, yeah, that's fine. Or if it's quite clear to them, well, it's just based on head count. And they'll say, well, is that the best way of doing it? And then you say, yeah, because of this. How are they going to challenge that? You know, who knows the business better than the insurer or the insured, and to say that that's a just or not allocation. However, there is this extra pressure for them to find this extra revenue. And a couple of examples that we've experienced or seen recently sort of highlight this. One of which is the Netherlands, where last year the IPT rate increased from 9.7% up to 21% overnight. It was a political decision. The tax authorities were almost a little bit apologetic when we were speaking to them and said, look, we're sorry, it's not our decision, but we've got to enforce it. And they were given targets by the government to say, you need to raise this much revenue from this increasing rate. We've now come to the end of the first year, and they've done all of their statistical analysis and looked at how much they've collected, and they haven't collected enough. So now the Dutch authorities are looking to find that missing tax. One key area that they're looking at is the transition period. So were people collecting their premiums a little bit earlier? Were they invoicing their premiums a little bit earlier to enjoy the earlier rate? And looking at that period, that issue. But another area is looking at some of the new schemes and the new way premiums have been priced to see if there's any what they would consider to be evasion there. There's been quite a lot of activity in the various different sectors at trying to maybe gain slight or reduce the tax burden a little bit. So the Dutch are out and they're looking. We'll see how much detail they go into allocations, how much they're prepared to say, actually, we want a little bit of that tax. But let's not forget that it was the Dutch that sort of instigated the Governa case to get their tax revenue. So, you know, they've got some experience of this. The other example that I wanted to highlight is that of Austria, the Austrian tax authorities. Now, I said there's not necessarily the expertise to challenge and really understand what's going there, but there is dialogue within the tax authority, not between tax authorities. So, you know, there isn't evidence of the UK tax authorities talking to the French tax authorities and saying, "Well, have you seen this taxpayer? No, okay, well, it's not so much evidence of that, but certainly within the tax authorities themselves, there's dialogue between the different taxes, the different tax departments of the tax authorities. So direct taxes with the indirect taxes, VAT talking to IPT, you know, corporation tax talking to IPT as well. And what the Austrians have seen a number of recently is they've been auditing corporate insureds, just a general tax audit. And part of that is to be satisfied that the premium allocation and the premium amount was correct for Austria and that those taxes have been paid. Now, whether they could actually challenge that allocation or not, again, we've mentioned, we're not sure. But what it is, it's an in. It's a way for the tax authorities to get in. And they may not pick it up on the premium allocation, but if they're looking at the premium allocation and they see something else which doesn't look quite right, that's maybe going to impact on the corporation tax, well, then they'll start to look in that way, bring in their corporation tax friends and hand over the audit to them to start digging in. So whilst the allocation itself is not under direct scrutiny from a tax perspective, it is a potential way for other taxes to be investigated. I sort of mentioned there this independence of each tax authority. So they're not really having a harmonised approach to this, and there is no requirement for them to be harmonised. So actually the allocation that is prepared by the insurer for the purposes of the policy may well actually differ from the tax allocation, where you have instances of double taxation or potentially no taxation because of the slightly conflicting ideas around location of risk, which if you've been in that session there, you'll be fully up to speed with. So there's not that harmonisation, there's different views, and you could find yourself, I mean, I've seen examples of UK allocations where HMRC have been looking at the allocation and everything's been allocated to the UK. Now HMRC in the UK are going to be fine with that. They're not going to question that allocation because they're getting the revenue. So they weren't too worried about telling their cousins in Paris that maybe there should have been some allocated their way. You know, it's very much focused on, from premium taxes, it's domestic level. And we're looking after ourselves. There's not that harmonisation through Europe. I don't know if anybody's had any experience with tax authorities looking at allocations and challenging them, and did they know what they were talking about? Were they? No.
We got rumors through different insurance companies. So they start to point out these things.
Yeah.
Why are you doing this company like this?
Yeah.
And you find out that otherwise I say you do it like this.
Yeah.
5 years later they pick something else. Another issue.
Yeah.
One last quiz question before lunch. It's a bit of a working example really, just to talk through of what you need to think of in allocating your premiums, and then additional costs that you need to build in. So we've picked an EU company buying their property damage business insurance cover from an EU insurance company to cover PDBI risks in the UK, Luxembourg, France and Austria. They've got £100,000 premium, and they've been provided the property value. So I think the quick question is first, how do you allocate the premium against the values? The answers are in the book, and hopefully no one's going to check my maths, because I'm not sure whether someone checked it before. Okay, so we're allocating the risk against the property values. So we're looking at the proportion of the risk for the property values and then applying that same amount against the premiums. So then we've got our base premium for each country. So in addition to that, what additional charges do we need to think of and build in? So, you know, we're not looking at taxes that are added onto the invoice that will be billed to the client locally or to the insured locally. We're looking at what you need to consider to build into your base premium. Any thoughts for any of those countries?
You may have different covers.
Sorry?
You may have different covers.
You may have different covers, yeah, but we're particularly focusing on this is PDBI, so we're looking at some of the additional factors you might have to build in for those for the UK, Luxembourg, France and the Netherlands. So if we start with the UK, we know the IPT in the UK is paid by the insured and it's added onto the invoice, but I don't know how many of you are familiar with, it's a small charge, but there is the London Fire Brigade charge for risk located in London.
So, yeah, it shows the importance of actually the detail of the allocation, because we've now got to work out actually what the element of the property is in the central London or inner London boroughs. It's an insurable tax at a cost of £35 per million sum insured. But that does build up, and if you haven't built it in, then you're going to have to find that cost somewhere. So it's actually starts to become quite a complicated way of working out how you're going to gross up your premium, what you've got to do to cover that, and what then the impact is going to be onto your IPT, which will also increase because you've had to increase your premium there. In Luxembourg, both taxes, fire brigade charge and IPT, can be invoiced to the policyholder, so no worries there. But in France, we have a number of pools and additional premiums to consider. We have the Gariat premium, which has to be paid on certain properties, collected on certain properties over various values, and also the catnap premium, which is an additional premium that has to be charged on top of the base premium. In terms of the PDBI, it would be a 12% additional premium, unless, of course, there had been negotiations with the CCR, who might say that it needs to be higher. Interestingly, if you're a tax geek, there's on the catnap premium, there are IPT to pay because it's increasing the premium being charged to the policyholder, therefore premiums are subject to IPT, so you have to pay the additional IPT. But there's also another charge, which is the Major Risk Prevention Fund, aka the MRPF, aka Fonds Barnier, and that's actually an insurer-borne tax. But there's a little bit of debate there about whether it's actually an insurer-borne tax or if it's sort of a tax almost borne by the catnap premium. So will the insurer have to suffer the cost of that, or can they deduct it from the premium that they're collecting? And if they do, what impact does that have then on to the IPT? Because you can't charge a tax on a tax. So if it's included within the catnap premium, do you have to deduct that from? And the authorities are unwilling to give any clear guidance on that. So it falls down to the taxpayer to apply the law correctly. You ask, how do we apply the law correctly? We're not telling you that. You've got to work that one out yourself. And then finally, the Netherlands. Again, nice and easy. A big tax, but it's invoiced to the policyholder, so not impacting onto the allocation.
That's the last question. Have anyone got any specific questions, issues, concerns, discussion points, jokes, anecdotes?
I have one question in relation to capital particularly, but do you ever run across the position where an organisation loads premiums by sort of internal risk management charges, and then there's an easy way of invoicing subsidiaries?
Well, they wouldn't really be visible to us. from a premium tax perspective, when the allocation comes in, we wouldn't necessarily have a breakdown of the underwriting technical premium. We would just
So
have
you
the
just
premium
wouldn't see it.
allocated per territory.
Mm.
So we would be calculating the tax on the figures provided.
Okay. I mean, I'm aware that's happened in the past. I've always been a bit uncomfortable. I would have thought it'd be a VAT.
Well, it's potentially on the premium, isn't it?
Exactly.
Yeah.
So it's not something close.
But I just wondered how often that happens these days.
Well,
You don't really wouldn't know.
no, I mean, I'm conscious, I'm aware that it does happen. I'm familiar with it happening, but as I say, from our perspective, we're provided with the premiums and then we calculate the taxes on those premiums, so we wouldn't necessarily question the build-up of the
I
premium.
would say it happens unfortunately very, very often.
Yeah.
And then you need to add an additional notification that if that management charge is sent to an entity in a country where none of it is not permitted.
Yeah.
Then maybe
Yeah.
it's a very, very bad thing.
Yeah, I mean, you could have a situation where you're providing effectively a service into that country, which is very legal as a service, but is illegal as an insurance product.
Clients do not often.
I guess when you've got a fronting insurer though, I suppose the fronting insurer would be validating, well, to a certain extent, that the premium was adequate and not too much.
Yeah, I mean, there's also the issue that a lot of fronting insurers have minimum premiums for territories for a policy.
Yeah.
And sometimes the minimum premium is going to be about the allocated premium, which actually not only distorts the premium for that territory, but distorts all the rest,
Very
because you
few.
allocate that first.
Yeah, that's true.
Sorry, another question. You're changing allocations. Had a couple of conversations with clients over the years whereby they have an allocation methodology which, should we say, is less than perfect, and they want to make it close to perfect. And there's also been this dilemma, well, if we change it, we're really highlighting the fact that it's been less than perfect previously. And you then get into the silly conversation, well, can we sort of gently change it from the old system to the new system, which is the worst of all, of course. I just wonder whether you've had any experience of dealing with that and how you respond to it. My advice tends to be you need to bite the bullet and just do it, because it's an easier conversation to say, sorry, we've become more sophisticated and we changed it, rather than trying to explain why you've got where you're sort of in between position.
That probably fits with our open and honest approach. You're less likely to be penalised if you're being honest and upfront about something than if you're...
Yeah. And certainly with the increasing number of countries and tax authorities which are looking towards behaviour-driven penalties. There's still a lot of territories that just say, well, there's your penalty, thank you very much, see you tomorrow. But a number, UK included, are sort of starting to build in graded penalties based on the behaviour of the taxpayer. Was it intentional? Is it a deliberate attempt, or was it a deliberate attempt? And have you come to us voluntarily? And so, that's always what we say, is that, if you know of something, you've got to tell them before they find it out, because the penalties are very different. You may get no penalties if you do it voluntarily and correct your position. From the tax perspective, yeah.
Anything else? A couple of minutes ahead of time, but not too far. So thank you.